if you have any questions on FxPro trading platform and what they're offering, I'm pretty sure the guys will be able to talk to you about it later. Okay, but if you've seen any of these live events, as you saw me earlier, I might get excited about some levels and so on. I just want you to kind of read this for 30 seconds or so. But basically what I'm trying to say is, and these guys from FxPro, this is not advisory. So I'm not telling you what to do, what to trade, and if we are talking about some levels or analyzing some markets, it's up to you to make your own decision. And the most important bit for me is this bit here. CFD, spread betting, margin forex trading is leveraged. And do you all understand what leverage is? Mm-hmm. You all okay?
Not really.
Is there somebody who doesn't understand what leverage is? Okay. Leverage is that what you trade and the position that you hold is so much larger than the initial a unit or a size per point that you are placing. Okay, that's what I'm trying to say. So this is the important bit for you to understand, because if leverage works in your favor, it's really good, but you also have to understand that it's the very, very important risk that you're taking on as well, because you're exposing yourself to a higher or a larger nominal value that you're holding rather than just what you think it is in per point terms. You all okay with this? Yeah? Okay. Let me put it this way. If you trade 0.1 lot of euro dollar, 0.1 lot, do you know what it is?
This is
size.
Mini lot.
Mini lot. One lot is
1 lot is
10. One lot is 1. Okay? And 1 lot in Forex is equal to 100,000 of the first currency. So euro dollar, you are trading 100,000 euros and are changing them into dollars. That's what you do with 1 lot. Okay? But you see it on your trading platform as 10 euros, 10 pounds, $10 per point, which is the 4th decimal place. All okay with this? So you see it as a 10 pounds, but what you do, you're controlling 100,000 euros against the dollars. You okay with this? Okay, so that's what I'm trying to say. It's not tenner, it's 100,000. And when this 100,000 goes up by 1%, your position makes 1,000. If this 100,000 goes down by 1%, you lose 1,000 out of your trading account. All okay with this? Good. Okay, I don't mean to scare anybody, but this is the most important bit. If you can understand what you're doing, that's good. So, I'll talk about this a little bit later, but this is in your control. You are able to manage your own risk. This is 100% in your control. Will euro dollar go up or down? We don't know. Markets are quite random to a degree. Okay, I don't want to bore you with this. I'm going to go and talk really fast. Now, this is basically just my opinions and experiences, not advice. That's what I'm trying to say. All okay with this? Yeah. Good. Okay. Now, golden rules for new traders. I would really be writing this down because it's useful. Rule number 1, never add to a losing trade. So that's the first rule. Rule number 2, never lose more than 1% of your trading capital at any one trade. So, some people can live with 2% loss. Anything more than 3% is financial suicide. Okay? But what most of the people, when they come to financial trading, what they don't realize is how much am I risking on each of these trades. They just see it as I'm risking 10 quid, 30 quid, 50 quid, 100 quid. Let me ask you this. Let me put it in real terms. Actually, I'll tell you the story. I was speaking to a guy 2 days ago, and this guy was actually filming me. I was doing something. And he said, oh, I want to get into this trading. I want to open up an account. I have 100 quid. I said, don't open your account with 100 quid. It's pointless. Have 10,000 and open up your account. And I was saying, but why? I said, this is the reason why. If you trade with 100 quid in your account, you'll place a trade and you'll say, I'm going to risk 50 quid to prove myself right. Because 50 quid for this guy or for anyone, anybody here is not really a life-changing amount of money. It's a round of drinks. But a 50 quid out of 100 quid account, it's 50% loss. So if that position goes against you and you lose your 50 quid, you're left with 50 quid in your account. You need to increase that 50 quid 100% just to go back to break even. Do you understand what I mean? So I've asked you the same thing. If you had, imagine you have 10 grand in your account and you decide to do the same thing. Would you be willing to lose 1,000? Oh, he can still live with 1,000 loss, but 1,000 sounds like a little bit more money than 50 quid. And 1,000 is only 10% risk of his 10,000 account. So you have to be realistic about how much money are you willing to risk. And what I'll do a little bit later, if I can, I will actually show you a little calculation, very basic calculation, how to do this and how to identify your risk and how to identify your position size. I think it might be helpful, especially if you're spread betting or doing CFDs. I don't think many people cover this properly. You all okay with this? So have predetermined rule of how much you're willing to lose and go into every single trade with the premise that you are wrong and you're willing to lose that percentage of the money to potentially prove yourself right. If you can live with that, that's great. Okay? Now, never trade anything you don't understand 100%. So we were talking about this earlier. So you say, what shall I trade? What's suitable for me? I said, I don't know, but what do you do? Okay, so let me just do a quick test. How many of you trade full-time? Sorry, work full-time. Okay. Is it 9 to 5 shifts? Okay, you guys are shy, you don't want to say. It doesn't matter. Now, if you're working full-time and you want to trade intraday, it might not be suitable for you. You don't have enough time to look at the screen all the time. And you might be jumping from one thing to another. If you're working full-time, you need to find something that you really, really understand. And you understand what the supply and demand is for that particular financial instrument. You understand what economic data or news might be driving it. You understand why a particular central bank, what they do or say, might influence what's happening and so on. And then if you're comfortable with that, trade that, because you'll know what it is. Okay, so we're all living, okay, I'm not living here, but if you're living in UK, for example, you should understand FTSE 100. You understand what FTSE is? No? Who doesn't know what FTSE is? Okay. It stands for Financial Times Stock Exchange 100 Index. I'll show you this later. It's the index, it's equity index that follows the movement of 100 largest capitalization companies listed on London Stock Exchange. And you have companies like Royal Dutch Shell, like BP, like British American Tobacco, like GlaxoSmithKline. These are the big companies and they have large market cap. And if they report their earnings, for example, and their share price goes up because they're doing really well, that drives the whole index higher. All good? Okay. The other thing is, if sterling currency falls, that's usually good for FTSE, because all these companies report in different currencies. So suddenly, because sterling is weaker, they can show more profits in euros and dollars. So FTSE goes up. If sterling goes higher, or maybe these largest top 5 companies report the bad earnings, so maybe there is a geopolitical event, maybe the CEO change, maybe oil spillage in States a few years ago, whatever else, and that drives the whole index down. So that's what it is. So you must understand what it is that you trade, and how it's calculated, and what drives it. So if Mark Carney comes out and says something, that might impact sterling, currency crosses, but also FTSE as well. All good? Okay. If UK unemployment data shows a bad number, that impacts FTSE as well. Inflation, GDP, consumer. So do you understand what it is? Okay. So really, really understand what you want to trade. Trade in the direction of your trading time frame. So, majority of the people don't have a concept of the time frames. Trading is multi-dimensional puzzle, and you have same financial instrument coexisting in different time frames. You have price, which exists in monthly, in weekly, in daily, all the way down to 5 minute and 1 minute. And each one of these might have a different trend. Okay? So you can have a biggest bear market and biggest selling pressure in weekly and daily time frames, but you can have a sweetest intraday rally in 1 minute, 5 minute, 50 minute time frame. So they have different trends, they have different triggers and so on. So make sure that you understand, have a concept of the time frames. Only look for low risk, high reward trades or high probability setups. When you do not have signals, do not trade. What I'm trying to say here, guys, is if you're trying to find something to trade, look for the disproportionate amount of reward for the potential risk that you want to take. Let me simplify that. Do you know when I was talking about 1% rule? Okay, so let's say that you have a trading system or a trading strategy, and majority of the strategies that you can come across online and buy them as the setups and so on, they go on a hit rate. They said this strategy was right 70% of the time. Okay? But what they don't tell you, the risk to reward ratio does not work. They're going for a hit rate. I would rather trade 30% right, 70% wrong strategy with 10 to 1 risk to reward ratio in my favor. If you're right, if you let's say you go for that strategy and you are right 7 out of 10 trades. 7 out of 10 trades. And every time you're right, you cash in £10, £50, £10, £50, £100, £10. When you're wrong, you lose 200. When you're wrong, you lose 500. 20, 20, 20, 50, 1,000. You'll blow up your account in no time. It doesn't matter what the hit rate is. Risk to reward ratio makes sense. If we play a game and we can find a setup where we are risking £10 to potentially make 90, I can be wrong 9 times. And on the 10th time, if I'm right, I'll break even. I'll play that game anytime. Out of 10 trades, all I have to be right twice to make money. So look for disproportionate amount of reward for the risk that you're willing to take. That's what I'm trying to say. Guys, you're too cool. Is this okay? Yeah. All good? Okay, fine. Now, trade your plan, your system, your signals, the chart, the price, not your opinions, bias, or prediction. And majority of the people do that. They say, I believe this will go up. And eventually you might be right. Okay, eventually you might be right. But markets can stay irrational for so much longer that anybody can stay solvent. So don't try and be right. Stay profitable. Okay, cut your losses quickly. Okay, trade only if you see something that's giving you a confirmation based on the technical system that you tested in your demo account over a long period of time and that gave you a consistent, predictable, positive outcomes. So you have a track record of what you did. And if you have that, trade that system. If you don't have that signal, don't trade. You can be short, long, and you can be in cash. Cash is a position. Okay? You can stay on the sideline. You're watching the game. Okay? That's what you're doing. Now, find a trading methodology that fits your personality. This is hugely important. I can spend the whole day talking to you about this. This is really, really important. Like we were talking earlier, you know exactly what you're doing. Because this is my day job, I finish by that time, and now I have this much hours per day to devote to this. So that's great. Majority of the people don't really go for that. They say, I'm going to go and be intraday trader. And I ask them, what do you do? I trade 9 to 5. You can't be intraday trader. Why? You have no ability to look at 5, 15-minute chart intraday. You are working as a shop assistant. You are at the till or you're manufacturing something. You're not in front of the screen. How can you trade intraday? Okay? You can trade maybe in end of day or a 4-hourly time frame because you get up in the morning and here in UK, 8 o'clock, you check your charts. You see, do I have my signal? Then you walk away and you check it again at 12, 4 hours later. Did I get my signal? Did the price hit the level? No. Walk away. Check it again at 4 o'clock in the afternoon. That's before European markets close. You still didn't get a signal. Check it at 8 o'clock at night before US markets close. And that's it. That's what you do. Then you're trading in 4 hourly time frame. You're reading 4 hourly chart. All good with this? So you must know what fits your personality, your lifestyle, your work balance, and so on. Don't trade before you have a complete trading plan, including rules of entries, exits, and risk management. Very important. The size of your wins and losses determines your trading success. We talked about this already. Okay? Your risk management rules will determine the success of your technical trading system. And this is the only thing that you can control. How much money are you willing to risk in order to prove yourself right? And I'll show you that a little bit later. Now, in order to have a holistic view of the market, and what I mean is to see market as it is, to see market as whole, okay, you really need three things. Majority of the people are saying, I am only a technical trader, or I am only a fundamental trader. Really, what you need technicals for the triggers and the levels that will be broken. You need fundamentals to understand supply and demand and why something is happening. And you need sentiment to confirm the direction of the trade. If you don't have all three, you're not seeing the market as it is. You are trading blindsided by one eye. You know what I mean? Okay, so how do you see sentiment? Chart tells you. Is it going up or down? You see sentiment reading telling you 80% of the people are bullish or bearish this financial instrument or whatever else. Okay? Sometimes you can use them as a counterintuitive analysis as well. Because if 80% of retail traders are shorting S&P now, and S&P is making all-time highs, you're going to go with the smart money who's buying S&P, or you're going to go with the retail traders who are shorting it in uptrend. So you have to put in the context of what it is. Fundamental. What's happening with unemployment? What's happening with rates? What's happening with consumer? What's happening with, if you're trading crude oil, for example, with how much oil is in the storage? Why did oil break out 2 days ago? I'll show you. I'll show you that in a minute. And so on and so on. So that's fundamental. And technical is, did oil break 47.50 level? If it did, it's likely that it might go to 48.60, 48.50, 48.75. And then you might stall there. Why? I'll tell you why. Because that's the resistance area. That's where other people are taking profits. If it goes higher, it's a breakout, more buy orders above that, and so on and so on. But it's driven by a huge amount of oil being drawn down from the supply. They used massive amount of oil in the last 7 days, more so than what they planned they would. That means there's less oil available. That's the supply and demand. That's the trigger. And the level was technical. So you need all three. All good? Okay. Now, no questions so far? Good. Economic data drive the markets. So this is the important bit. Do you use economic calendar at all? Yeah? Okay. So, if you go to FxPro, which is, let me see if I can get there. FxPro. Here. You can go into trading tools. This is just, you don't even have to kind of log on to your trading platform. It's just here. Go into economic calendar, and that gives you this wonderful thing. It tells you what's happening today, what time, and what is the consensus or a forecasted figure, what's the published figure. And then if you see something that's relevant for you, so if you're trading Mexican pesos against dollar, you don't have to really worry about what's happening with sterling. You want to worry about what the Federal Reserve is doing or something like that. If you're trading oil, you must know what's happening with oil. So some of these, okay, they have significance attached to them more so than the others, because you must trade what you know. So that's the economic calendar as well. Okay, and then I'll go into this PowerPoint again. So, do you all use economic calendar?
Yes.
Okay, good. Okay, good. Now, set up your charts correctly. Your charts have to be set up according to your trading style. So, Do you use candles? You must have at least one momentum indicator on your chart. Just one. And that momentum indicator is telling you that what your eyes saw really happened. That momentum indicator is lagging the price so much that it's almost irrelevant for you to potentially use it to predict anything. But it's only confirming to you that trend is intact. And that's what you need. So you need to go and say, if trend is up, I'm going to buy the pullback, I'm going to buy the breakout. I cannot short. If you short, you're bored, give yourself a slap. Okay? So, one moment, either MACD or moving average or something like that. And then have at least one oscillating indicator just for confirmation. If you get a pattern confirmation, if you get a candlestick confirmation, if you have the news in the economic calendar confirmation, and one of these babies confirm it as well, just maybe you might be right. That's all. Okay, there's no certainty. All good. Using multiple time frames. This is hugely important as well. So, you must know what is the time frame that you trade in order to identify your trend. Is this new for you, or did you see this before? Don't be shy. Please help me. Is this new? Okay. If you are trading in end of day time frame, so let's say you are one of these guys who works full time, and you cannot see your chart during the day. You do your analysis over the weekend. It takes you about 2 hours to read stuff. Okay? And then you place orders in the system, so while you're asleep or at work, and if those orders get filled, then you're traded. Or those orders might be triggered when you're at work as well. So your trend is based in monthly and weekly time frames. So you want monthly and weekly to uptrend and daily to fall, or daily to break out in order to find something to trade. If monthly and weekly are selling off and daily is rallying, you're looking to short. Is it all okay? So your trading time frame is moving in the opposite direction of the prevailing trend. Is this okay?
Yeah.
Confusing? So 4 hourly, daily and weekly, 1 hourly, 4 hours a day. And it has to be in this order. Majority of the people, when they come in, they open up the chart and say, I'm going to trade here, and then they go and start clicking to changing time frames to find something on that chart that will justify their bias and prove to them that they are right in their analysis, instead of letting price action and the news and the chart to tell them that's what they should do. The reason for that is 4 of these is in one of these, 5 of these in one of these, 4 of these is in one of these, 4 of these is in one of these. So these 2 are longer time frames, and this is your shorter time frame. Okay, they have to be in that order. Okay, so when you're trading in an hourly, don't go clicking in 15 minutes or lower. Don't go clicking in monthly. That's irrelevant. Absolutely irrelevant. Okay? Now, multiple time frame analysis. It's useful to have multiple charts for the same financial instrument displayed in front of you, so you can have a quick glance and see this is uptrending, this is uptrending, this is uptrending, this is selling off. What am I doing? Yeah, this is daily, 4 hourly, hourly, 15 minutes. I'm a 15-minute trader. Daily is uptrending, 4 hourly is uptrending, hourly is uptrending. Higher highs, higher lows, higher highs, above rising moving averages. 15-minute is selling and creating a double bottom reversal. What am I supposed to do? Go along. Am I allowed to short? No. Majority of the people short. Okay? Now, what I've just shown you here, there is a company just around the corner that packages this as a 2-day course and charges you $2.5 grand for this. So this is basic stuff. This is really, really basic stuff. Okay? Now let's look at some stuff that you want to talk about, because markets have 4 stages and they keep on repeating over and over again. So it's either basing or uptrending or topping or downtrending. So if it's basing, it's going sideways, or it's creating a rounding bottom, inverse head and shoulder, double bottom, triple top. Are you all okay with this? Then it breaks out, and then in uptrend you have kind of expansive move and then corrective move, and then expansive move and a corrective move. It does that all the time, until one point it stops creating these higher highs and higher lows and starts reversing. I really want to show you this. I really do. Okay. Now, I think this would be very good for you to see. Okay. Let me show you these 4 market stages. I'll be fast. So, let's say this is the first stage, sideways consolidation. In this case, majority of the people can draw support and resistance. And people who are trading the range, can you see this at the back? Yeah.
Yes.
They will be looking to buy here, take profits, put the stop loss below. They're looking to short here, put the stop loss, take profit. They're trading the range. Okay? And normally you would have some kind of moving average somewhere. That moving average is mixed with that price. It's not clear cut. At some point, this breakout happens and creates a first higher low. Okay? And then what happens at that time, you have a previous resistance which now becomes the newly found support. And then the trend goes and does something like this. It goes up. Okay? So then what happens here? You have your topping head and shoulder pattern, or wonky triple top, or whatever name you call it. Okay? This is a difficult bit to trade. What's happening here is this. You have moving average which is going higher. So the price is creating higher highs, higher lows, and the moving average is moving higher. Okay? And then at some point when this starts happening, the moving average starts curling and the price action falls through the moving average. Then price action falls through the neckline. Okay? And then what happens is this. The price goes below the neckline, goes underneath, and this is our newly found resistance. And then it starts creating this, and it goes down. So these are the 4 market stages, and they keep on repeating over and over again in different time frames. Okay? So what happens here is this. This is the stage number 1. This is for speculative traders who can trade the range. Disciplined traders are waiting for the first breakout, and they place a half of their position here with a stop loss below. When they get confirmation, because sometimes this goes back inside, so it's a false breakout. But if they get the confirmation, they might look to place another half here. Then they're fully invested. And if it goes up, they move the stop loss very quickly, either above a newly found trend line or below the moving average. So this amount of risk is what they carry. This amount of risk in points determines their position size. I'll show you that in a minute. All good? Okay. So this is a stage number 2. This is uptrending market. In stage number 2, you are only allowed to go long. Majority of the people are looking to short. You can trade the breakout, or you can trade the pullback, some kind of pullback. Let's say this goes up, and then we have a trend line, and there's a pullback into a trend line. To put in the context of the multiple time frames. So your daily and 4 hourly are uptrending, and your 1 hourly is selling off. When your 1 hourly time frame hits daily support and 4 hourly support and starts reversing, maybe, just maybe, that might be a confirmation that you're looking for. And then look for your stochastics to cross over. Look for something else based on whatever you have as a technical system. All good? Okay. So then in here, then this is the stage number 3, which is a top. Okay? Topping is difficult to trade because speculative traders are trading here. Disciplined traders are trading around here. This here is where investors come in. Guys who are doing buy and hold. And now you're saying, well, will this work in 15 minutes? Yes, it will work in 1 minute, 5 minutes, 15 minutes. Every time frame it works. So, but people with a longer term view are getting in here, because then they got a confirmation of the trend reversal and the sequence of high highs and high lows. So they are still invested in here. This is the first warning sign. When the price dips below this trend line, high high, higher high, low, same high, or lower high if it's a head and shoulder. Okay, so this takes a bit time to form. This is the second warning sign, the price dipping below moving average. This is the confirmation for the bearish traders, loss of the neckline. This is the confirmation that the trend changed when the price goes in and reverses. And what happens here is something like this. You get three, 5, or 8, or 8 green candles, which is then followed by one of these babies in here, or you get one of these babies. This is green, this is red. Or you get one of these babies in here. Are you all familiar with them? You know what they are? This is the alphabet. Okay, you're trying to read the book. If you don't know the alphabet, you cannot read the chapter. You must see. This is your sentiment in real time. So, then trend changes and this becomes a stage 4, where in here it's downtrending and it's only shorting. Short the resistance, short the moving average, short the loss of support, short a continuation bearish pattern, and then do what we did with dollar yen. Do you remember? That's how it works. So don't make it complicated. All good with this so far? I'm flying through this, guys. I know people charge money for this. Okay, now let me show you something else, and this is really important. I urge you to write this. I'm serious. If you have 10K in your account and you're willing to risk 1%, you're risking 100 quid on a trade. All good with this? Okay. Now, can you all see this from the back? You can. Yeah. I need to go here because I can't write with my left hand. So it's kind of lights in my hand. Now, how do you identify the position size based on this risk? How do you know how many lots, how many pounds per point, how many contracts you might be able to trade based on your account size, based on this calculation? Is there anything that might tell you?
Leverage. The leverage.
Yeah. Let's do this. You're risking 100 quid.
Yeah.
You divide that monetary risk by the distance of your stop loss order to give you the answer. So if you traded euro dollar and your stop loss is 100 points lower than where you entered, the maximum you can trade is 1 pound per point, or 0.1 of a lot, or 1 mini contract in CFDs. If you do anything more, you're not risking 1%. Newsflash. Okay? Now, let's do the same thing. 100 quid risk with a 50 point stop loss. That gives you 2 pounds per point. If you do the same thing, but you found a setup that's giving you a 25 point stop loss, that's giving you a 4 quid. If you find the same setup and you have a 10 point stop loss, that's giving you a 10, which is the lot. This is important because if you find the trading setups and you're disciplined to wait for the ultimate confirmation and you get in that candle shape, reversal, and let's say from here to here is 50 points, so your stop loss is here somewhere. You must wait for this candle to finish before you can enter when another one opens. Yeah? Do you know what I mean? So then you say, if I'm risking 100 quid, I can only do this with £2 per point, or point to lot. If distance of this candle finishing, or let's say this candle, from here to here, and your stop loss is here, and this is 10 points, then you can trade the same thing with £10 per point. So the price action tells you your position size based on your predetermined risk that you're willing to carry. Okay? So that's why it's important to have multiple time frames, because if you are trading in 1 hourly time frame, it's more likely that your stop loss will be much tighter than somebody who trades in end of day time frame. If you're trading in 15-minute time frame, it's more likely that your stop loss will be tighter than somebody who trades in hourly or 4 hourly time frame. So it's all relevant. Okay? Now, then what you do is you have to be ultra realistic about your expectations of the potential return at the end of the year, not in one trade or tomorrow or in 2 weeks' time. And this is the difficult bit for people. So majority of the companies like FxPro or any other brokers around here, they would be able to offer you 100 to 1, 200 to 1, even 500 to 1 leverage. So let me put this in a very simplistic calculation so you'll know what I mean. 10K with 200 to 1 leverage is equal to 2 million. So your 10K account is not 10K account. With the leverage, and because you can trade on margin, you can potentially, it's a crazy thing to do, because you will not have any money left to cover price movement. But in theory, you can control a nominal value or exposure worth 2 million. It's a beautiful business to be involved with. How much money do you need to buy a house?
10%. Say like 10.
No. What I mean is you go to the bank and you say, I have 10K, would you lend me 200 grand to buy a house? They'll tell, bend over and give me a half a liter of your blood and, I need to check your DNA. Are you crazy? Do you understand? So if you go to the bank and say, I have this beautiful business idea and I have 10K, would you lend me 50K to start the business? They'll tell you, are you crazy? Okay? But you can go to derivative brokerages and they will be able to provide you with as much leverage as 200 to 1. So it's up to you to understand it. That doesn't necessarily mean that you should take it all. Okay, but what I mean by this is be realistic about your expectations, about your return. So if you have 10K in your account, let's say, and do you understand the compounding? Yeah? Let's say that you are able to make a 6% per month consistently and compound that over a 12-month period. That will double your account in 12 months' time. 6% is amazing per month.
Just 6%.
Yes, see, that's the face and that's the feedback that I get every single time. People are like, oh, 6%, but that's 600 quid. I have 10K in my account, 600 quid. Are you crazy? I can do that in one trade. It's a lot of money. Good hedge fund makes 22%, 25% per annum. What makes you think that as a novice trader who never traded live or in a financial institution that you can make consistently? I'm talking about consistently. That's the issue. So because of the leverage you can, but you have to be aware that that's not always the best thing to do. Because if you're aiming to make more than 6% or 5% or 10%, you might be over leveraging yourself. You're taking too much money from your imaginary 2 million. Therefore, if it goes against you, it will make a big dent in your trading account. And one of the rules that you should have, if I lose more than 30% of my trading account, I must stop trading. Go back to the demo, go and read some books, go and speak to some people. And then when I'm ready, go back. What most of the people do, they put more money in. Why? Because there's the same guy that I was telling you earlier, he put 100 quid in his trading account. He lost 50 quid. He said, oh, who cares? I'll put another 150 quid. Before he knows, he funded his account 10 times. Okay? That's the reality. But it's such a small amount of money, and it's not life-changing amount of money, they don't feel it. It's a round of drinks. Respect it in percentage terms. If it was 100 grand, would you treat it in the same way? If you had 100 grand in your account and you lost 50 grand, how would you feel? Yes. Okay, so that's what I'm trying to say. So, have kind of a business structure. So this is equal to 600 quid. So you're trying to make 600 quid at the end of the month. And then what you do is, you say, based on my personality, based on my lifestyle and work kind of balance, I'm finding that I can trade euro-dollar in 1 hourly time frame with a 50-point stop loss. Most of my trades are, markets will tell you where your stop loss is. But based on your experience and your technical trading system, you're likely to find loads of setups with 50 points. So you say, this is my base unit size. So then you divide the 600 quid by 2 pounds per point, and that gives you 300 points that you need to make at the end of the month. So then what you do is, when you write your little rule, my name is so-and-so, I trade euro-dollar in 1 hourly time frame. I always trade in the direction of, nobody's writing this, this is gold. I'm always trading euro-dollar in 1 hourly time frame. I trade in the direction of the prevailing trend, which is identified in 4 hourly and end of day time frame. I always risk 1% or less of my trading account per each trade. I go in every single trade with the premise that I'm completely wrong, and I might be willing to lose my risk in order to prove myself right. I am always looking for 3 to 1, 5 to 1, 10 to 1 risk to reward ratio. Otherwise, I do not trade. And I keep detailed transactions of every single trade. Audit trail. What did I learn from this? What's coming up in the economic calendar today? What news are coming up which might cause this to move, and so on and so on. All good? Then that's your statement. When you write it down and you put it in front of your screen, not online, in front of your screen, or a whiteboard, or a piece of paper. So when you're trading, you're constantly reminding yourself, I have this much money under management. This is my position size. I'm aiming to make this, and this is equal to 300 points. And this is who I am. And then, if you come to an event like this, and this guy tells you about dollar-yen, and you go home and you trade dollar-yen, give yourself a slap. Because you're not a dollar-yen trader, you are euro-dollar trader. Okay? So you must know who you are. Now, the reason why I'm telling you this is because if you do this, and you write your P&L, today I traded euro-dollar, and I lost 20 points. And then I traded euro-dollar again, and I made 50 points. And I traded euro-dollar again, and I made 100 points. And I traded euro-dollar, and I lost 10 points, and so on and so on. So then your monthly P&L says, I am up 250 points. And you have open position that's giving you 50 points. You're in cash, you're in the money. What do? Do you let it run to infinity? Or do you cash in that 50 points and achieve your monthly target, and suddenly you become more relaxed? Then you're treating it like a business. If you had a business, the point of having a business is to go and deposit money in your bank as often as possible, not withdraw money from your bank and put in your trading account. Every business has expenses. That's the spread. So you must find a broker that's giving you a good spread. Broker that's giving you a good functionality, like good charting, news, economic calendar, Squawk, stuff like TraderCast, free of charge. If you were to go and pay that, somebody else will cost you hundreds per month. You understand? So you're treating it like a business. And the other reason why I told you this is you're disassociating what you're trying to do from making or losing money. You're playing number of points game. You're making points. Each point has a monetary value associated with it, but you're playing points rather than money. And this will help you from the psychology point of view. You're all very quiet. I don't know you personally very well. If we had more time, we could do an exercise. I would ask you a few questions, and then I would tell you which one of the trading fears is the dominant for you, and what's your biggest trading strength, and what's your biggest trading weakness. But let's do a quick example. How many of you are outgoing people? Don't be shy, come on.
Yep.
Not outgoing, one outgoing. Great. Rest of you are passive. How many of you are completely task-orientated people? Okay, so you are all passive and people-oriented people. You don't care if I tell you, we need to do this, and it needs to happen within the next 2 days. You wouldn't care about it. You would say, it's okay, I'm more concerned about how will that affect us as a group. You okay with this? Okay. Now, how many of you play musical instrument? One. Okay. How many of you, okay, is anybody accountant or software engineer? Ah, good, I'm narrowing it down. Okay, cool. So you're accountant, you're excellent, good. Okay, fine. So you have 4 broad ranges of people who are trading. Okay, and I'm going to use you for example. I'm really sorry because you were honest and used to it. Okay. If you happen to be an accountant, an engineer, a software developer, okay, and if you are a little bit passive, you're happy with a small circle of friends, and you do need to understand the detail of everything before you engage with it, okay? You are something as which is known as highly analytical trader, okay? You, my friend, are absolutely amazing in analyzing everything in a minute detail, okay? And when you trade, the biggest issue is that you hate to be wrong. Okay? You're laughing.
That's true.
Okay. You hate to be wrong. You are comfortable with losing money, but admitting to, not to other people, but to yourself that you were wrong in your reading of the market is very, very difficult. And that's your biggest downfall. You must, if you're feeling like that, recognize it, because what people tend to do who feel like that is they remove their stop loss. Yeah?
Just
Nodding?
absorbing more and more losses.
That's it. So you hate to be wrong, and you move the stop loss and you say, it's only a paper loss, it'll go back in my favor. And that's the biggest issue with people who fall into that category. So if I asked you a question, you would give me 3 different answers. And none of your answers were wrong. I did not give you a specific enough question for you to give me one answer. So when you trade, your motto is, if anything can go wrong, then it will. You know exactly what you want to trade, where you want to trade it, the level that you want to trade it. You know economic data that's coming out that might trigger it. And then when the price goes to that level, what people tend to do, they say, ooh, what if Mario Draghi comes out and says something? I better go and click on a monthly time frame and just double check. Let me just double check on the economic calendar. By the time you did that, the price already went. And at that time, you start eating yourself up from within. It's an inner civil war, and you start chasing the price. And then what happens is this. Your confirmation is no longer 50 points. It's now 75 or 100. Is it all falling in place, what we were talking about? So then you chase it. And then you're risking too much, your risk to reward ratio is not right, and so on and so on. So I know we have very short time, but we will cover in quite a lot, guys. We're covering quite a lot. So the idea is that we'll go into live markets now. We still have, yeah, and then we can analyze something. Before we go and do that, I just want to show you this. Okay. Now, TraderCast is a platform. I'll show you what TraderCast is very quickly. These guys at FxPro are will enable you to access it for a limited amount of time. Now, this is what TraderCast looks like. Don't be afraid. This is the home page where you get your watch list, you get signals, which are statistical pieces of information telling you that something is happening in your watch list. This is for your sentiment. I don't want to bore you with that stuff. You get live casts. This happens 9:30 in the morning until 11 and 1:30 until 3:30 every single day. If you have time, you can click on it and watch it in real time. And basically you see the camera pointing to the presenter and also the charts. So what I was doing here in front of you with the dollar yen, if that makes sense, that's happening every single day for indices, for forex, for commodity, anything that's kind of topical and so on. Okay? Then what happens here is anything that we discuss in charts, then we save and we post it. You have multi-view as well, so you click on here and you get 4 different charts as well on the same instrument, and then our analysis is posted in the community. So as members, you can click on this level and say, dollar yen. There is a dollar yen, and point of control 111.50, confirmed breakout above appears to be bullish targeting upside resistances, and this is the reason why, and blah blah blah. So this is covered during the broadcast, but it's also posted in the community. So that's what it is, and this might help you with your own analysis. Okay, if you choose to comment on that, the person who posted it will receive your notification. You can also go into the chat rooms and engage with other people. So that's what TraderCast is, and you also have plenty of education in the video form. Okay, so
Put a percentage of probability on your charts on the previous slide.
this,
Yeah. So someone like Auto Chart is publish something with a percentage of
there is no problem because I'm publishing this in 1 hourly time frame, but you could be trading in a 15-minute time frame. You would be looking to sell here, where I'm looking to buy the breakout. It's the same level, but we have different trends, we have different reasons for a trade. Okay, so how we come up with the level, the more people that come up to the same level, or more reasons why the level might become important, is the value. But what you do with that information, it's up to you. All good with that? Okay, so, and then you have education as well. So I'm not here to promote the TraderCast, but this is what it is. So you have access to that. And the way you can get access to that is by doing this. Okay, this is for FxPro Live account holders. When you go to tradercast.com and click on sign up, okay, you get one of these screens. Put your username here, create your username. First name, last name, create the profile name. This is what's going to be visible in the community feed. So call yourself FX Trader.
So username is your
Username
live,
is
your
your-
live name from FxPro.
No. You
Just
create
make
it
it up.
up. This is
Oh,
different.
okay.
This is different. Yeah. So you make it up. Yeah. So create username is something that you'll be using to log on.
Okay.
That's all it is. Okay. Profile name is what's visible. Email. Use secondary email address. Occasionally we send a newsletter if there's something coming up like FOMC or unemployment. But that's all it is. Or if you need to reset your password, use it for that. Okay? Create your password and all of that. And then in here, in introducer field, put FxPro. You must put FxPro in here. Click on terms and conditions. When you click on terms and conditions, that will take you to the payment stage. At this point, log out. Do not leave your card details. Do not click on a PayPal. Because I will need to cancel it. And it's causing me hassle. Okay? If you're using FxPro, these guys are sponsoring this access for you for a limited time. All good? But as I said, this is for live accounts only. So I would need to speak to these guys, and if they tell me, yes, this guy registered, can you activate his account? I will. And you're more than welcome to come and join us. Okay? So that's TraderCast. Now, any questions on this so far? No. Let's go into the live market and see if we can talk about anything that's happening right now. Shall we see anything in particular? Does anybody want to see anything in particular?
Let's look at oil because it's quite topical at the moment.
Oil. Oh, lovely. Oil is brilliant. Now, let me show you what's happening with oil. Oil above this level, 48.50, 48.75. It's a really, really good level. I'll put it here, 48.75. Can you all see this?
A little bit.
Is that better?
Yeah.
Okay. Now, oil was downtrending for quite some time. There is your top information, lower high, lower high. Yeah, this is downtrending. This is daily. Okay. Even in weekly and monthly, it's downtrending. There's no denial. We have OPEC meeting recently, and they're looking to cut again or extend their production cut. So control supply and demand. The issue with this is that OPEC no longer control all of the supply to the market, because you have non-OPEC members like fracking and so on, and they're pushing the oil prices into the market. Also, the rig count is increasing as well. So there's more oil being pumped, and these rigs are becoming more efficient. Now, the reason for this breakout here is found here. So every Wednesday at 3:30, unless it's a holiday in states like the markets are closed, then they move it to a Thursday at 4:30. But every Wednesday at 3:30 you get a report which is called Crude Oil Inventories. And this report tells you how much oil, and this is on FxPro free to access webpage. If you don't know what this means, click on it and it will tell you. Okay? So now, what's going on is this. The market was forecasting a drawdown of 2.62 million barrels. Analysts are saying it's likely that within the last 7 days, 2.62 million barrels were used in US. This is just for US, in a place called Cushing. This is West Texas Intermediate. This oil is lovely. It's light, sweet crude. You make more derivatives out of this oil. This oil comes in from dodgy places like Nigeria and Middle East, and Americans don't really like that. Also comes in from the Gulf of Mexico. But the Brent crude that's traded here in London is a sour crude. It's a lesser quality oil, but it comes from Saudi Arabia. Now, historically, crude oil traded in the US was always higher priced than Brent because it's a better quality. But now Brent is higher than, I don't want to go into this now. I just want to tell you why this happened. This was published number, minus 7.2 million barrels. So market was expecting 2.6, and it was a drawdown of 7.2. So what does that information do to, do you remember that triangle that we were doing? Sentiment and fundamental.
They're driving it down.
Driving it up.
No, there was more oil consumed
okay.
than what they were forecasting. That 2 millions will be consumed, but 7 millions were consumed. Yeah?
Yes.
So that's bullish for oil. That's bullish for oil. Also, if dollar falls down, oil goes up because it's traded in dollars. So that's the reason. Now let me show you what happened. The level that everybody was looking at that time was around here, this breakout here, these previous highs and a breakout. The next level that was really, really important was at 48.50, 48.75. Okay, the reason for that level is because it's a multiple fib. Multiple fib. Look, from this swing high to this swing low, 68, 61.8. Look, from this swing high to this swing low, 50%, 61, and then 200 period moving average. And also, you have the trend this way, and then you have a trend line this way. So when the first trend line is broken, like this one here, retest, the price wants to go to the next level. There is no certainty that it will, but it wants to go. Why? Because that's where the orders are. If I was long, this is where I'm taking profit. If I'm taking profit, this is where my sell order is. And there is huge amount of kamikazes who want to short the bloody thing there. They have the sell orders there as well. So the price goes where the money is. This guy is laughing. I am honored to be in the presence of this guy. This guy traded on the floor of life. He had a seat on CME. So if you have a chance to speak to him during the break, he can tell you so much more than I can. And also these two guys here, they're just nodding here, they're being very quiet, but they know their stuff. I don't know if Eduardo is coming, there's another guy there. So borrow their brains. They can't tell you maybe as explicitly as I'm trying to because they work for FxPro, but speak to them. Okay, they're here for you. So that's the reason for it. So oil is bullish above that level, and now we're hitting 49. Above 49, what's the next level? 50. Why? It's a round number. Oil was around 50 before. Us traders, we're a stupid bunch. We can remember round number. We want to have our orders where the round number is. You don't have to think too much. But that's where the money is. That's where the liquidity is. Okay? So now, let me show you the same thing here. So, yet again, I'm not doing this to promote it, but I want to show you this. So we have crude oil posted ahead of the inventories. Here we go. So, come on. WTI crude testing 61.8 Fib resistance ahead of the inventories. Very important. Point of control level at 47.50. Shaded area. Previous high breakout. You remember what we were talking about stages? Breakout retest. Now, important resistance above that is at 48.75, which is also a full 61.8 Fib retracement from the swing high to the swing low. Breakouts above that level targets upside resistances at 49, 49.80 and 50, 50.75. So these are, I'm not telling you go and trade long. This is the information for you to make your own informed decision based on your technical system, in your time frame that you tested over a long period of time, in demo account that's given you a proven, audited, expected outcomes. You all okay with this? Good. Now, so, alternatively, there is always alternatively. Alternatively, confirmed loss of point of control. So if you lose this level here, come back down to here, test it from underneath, then it's bearish. Then maybe the number that came in shows oversupply. They said, oh, there's 10 million barrels in reserves. Oil is coming out of our ears. We don't know what to do. We have nowhere to put it anymore. What would that do to oil? He'll drop. So supply and demand, okay? And then it's 47, 47, so on. So that's how it works. All good? So at the moment, crude oil is quite bullish. Some profit taking is very, very likely around this level because it's 200 period moving average. We have this falling resistance trend line, and it's also a multiple fib retracement. So anybody who trades fib retracements will be looking to take their profit there. Anybody who is trading and he thinks that this is downtrending market, they would be looking to short there. Anybody who was long trading this breakout are taking profits there. So that's why it might consolidate for a while. This is daily. This is 4 hourly, and then this is hourly. So what I'm looking at this as an hourly type trade is I'm looking at the sequence of this previous high, this should be blue, apologies. Okay? So let's make it blue, because it's our support. Red is our resistance. And I'm looking at this. So intraday traders are looking at this area here. And they're saying, if the price goes down here and stays down here, starts bouncing from here, it's still bullish. If it loses that, it's likely that it might drop here. Why? There is 200 period moving average. There is a trend line. Loss of this area would open up the way for the retest of the next level, which is down here, and so on and so on. And then you put those levels on your charts, like so, and then you wait. Do you remember that candle formation that we were talking about? You're waiting for your piercing. You're waiting for your star reversal. There is red, green, dodgy green. You're waiting for your bearish engulfing. You're waiting for something that you used before. You're waiting for your alphabet to tell you. Okay? As a confirmation. And then the distance of that, where that candle finishes and where you opened to where your stop loss is, determines your position size, subject to your account size, subject to the predefined and hard-coded risk that you're willing to take on each trade to potentially prove yourself right. All good? Okay. So that's how it works. That's how it works. Half past? Do you want to see something else very quickly? One more or?
Yeah, euro.
Euro dollar?
Yeah, please.
Okay. There you go. Euro. So, Mr. Mario Draghi is trying so hard not to appear hawkish, but markets don't believe. And I don't know if this is daily euro dollar. This is weekly euro dollar. Look at this, 200 period moving average. Massive resistance. Also, if you take fibs from here to here, it's 38.2. So you have people who are looking at moving average, people who are looking at fibs, people who are looking at trend lines are all possibly looking at that level there. So now, daily looks like an uptrending market. Now, is this stage 1 or 2? 2. So there's your basing, yeah, there's your inverse head and shoulder. Do you remember what we were talking about? So there is a shoulder, there is a head which has double head, double bottom, and a shoulder. And then the price did that. First, higher low in the stage number 2 breakout. You know what we were talking about? And then the price makes consolidation. And these are the same measured moves. So you have expansion, contraction, consolidation, expansion, contraction, and so on and so on. So they are measured symmetrical moves. Now, what traders who are looking at euro at the moment are saying, 1.17 is very, very important, psychologically important level. Okay, so they're looking at the trend line going here, and they're saying that the price is creating higher highs and higher lows above rising multiple moving averages. This 1.17 is important level. If that level doesn't hold, then potentially price can come down here and do something like this. This is where longer term buyers, based in 1 hourly, 4 hourly, might be looking to test it. They will be looking to put their stop losses down here, and they're looking to take profits either here or 1.1880, 1.90. So that's what they're kind of looking. Why? Because you have trend line going this way. So you have a trend line going this way, ranging something like that. You can look at the expansion and so on. If the price doesn't do that and instead does something like this, so we have a loss of this support and the retest of that support from underneath, which is our previous low, then this changes and maybe what becomes head and shoulder, then the next logical level of support comes down here. So it's either one of these previous highs or this low, which happens to be a 200 period moving average. So these levels here would definitely be a support from somebody who is looking to trade this in a trend line point of view. So this area here must hold for them. If that's lost, an end of day candle closes below that, it would change the structure of the trend and so on. This is 1 hourly time frame. And this is a 15 minute. So 1 hour is uptrending, 4 hours is uptrending, daily is uptrending. As long as it's uptrending, anybody who's looking to trade this and wants to trade in the direction of the prevailing trend, they are logically looking for something that will give them confirmation to find long setups based on their technical system. But we are overextended. So when you see, do you follow dollar index? Yeah. So there's another financial instrument which is. Do you have dollar index on FxPro? Yeah. There's another financial instrument. It's called dollar index. Some brokers call it dollar basket, or they have different name for it. But it's basically like a FTSE that we were talking about earlier. This is a Forex index. And this index follows the movement of US dollar against the basket of 6 currencies. Watch this. Euro, sterling, yen, Swissy, Norwegian krona, and Canadian dollar. Euro because of the velocity of the money. Euro dollar is the most traded currency pair. Sterling used to be the former reserve currency. Yen is dollar yen is the second most traded currency pair. Swiss because of the neutrality. Norwegian krona because these guys are sitting on oil and gold. They're rock solid. And Canadian dollar because they're neighbors. Okay? So, when the dollar index, which is now trading at extreme lows because nobody believes Fed, and this is what Fed did. They said they will, it was in line with expectations, the inflation is it's running below the targets, not close to. Now it's running below the target of 2%, and based on the non-farm payroll, the expectations for unemployment and job market is quite positive. And markets still don't believe them, that they will be hiking rates at some point in the future, or that they will be doing more tightening and so on and so on. So at some point, dollar index will reverse. Dollar it's at extreme levels at 93. So when dollar index starts basing and breaking out, and dollar index makes the move of 15 to 20 points in that trading day, euro dollar will sell 150 to 200 points. They're inversely correlated. So keep an eye on dollar index, and dollar index is driven by what Federal Reserve does or says. It's a hugely important instrument to have on your watch list. If you're trading gold, if you're trading copper, if you're trading silver, if you're trading oil, if you're trading any commodity, keep an eye on it. If you're trading any US dollar currency pair, keep an eye on dollar index. If you're trading US equities, keep an eye on dollar index as well. Sorry guys, we're all overrunning. I can talk to you about this stuff until tomorrow. I really love this stuff. And so, hopefully it was good. And I'll talk to you a little bit later over some glass of wine.